start this new chapter, Absorption and Marginal Costing. In previous chapter, we did absorption costing, and we know that absorption costing is a method of calculating the cost of manufacturing one product, cost of manufacturing one unit of product. In contrast with absorption costing, there is another method which is called marginal costing method. Marginal costing method is also called variable costing method. So let's see how does the marginal costing method it works. So if you remember that we have got 6 types of cost. We have direct materials, direct labor, variable manufacturing overheads, fixed manufacturing overheads, then variable selling and administrative expenses, and fixed selling and administrative expenses. So out of these 6 different types of cost, these first 4 ones, these are called production cost, like direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. These 4 costs are production cost, and these last 2, these are non-production costs. So you forget about these last 2 because we are calculating the production cost of making one unit, the product cost which we call. So of course in product cost we only speak about production cost. So the absorption costing method which we did in previous chapter, it says that the unit of any unit of output, it consists of 4 cost elements: direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So 4 cost elements, they go into the production cost, or what you call product cost. This is what we did in last chapter, absorption costing. Now marginal costing, it says that the production cost of any unit of output, it consists of only these 3 elements: direct material, direct labor, and variable manufacturing overhead. Fixed manufacturing overhead you do not include in the product cost. So here the product cost under marginal costing, which is also called variable costing, the production cost, it includes only 3 elements, and these 3 are variable cost. Fixed cost you do not add. So fixed costs are not added into the product cost. In absorption costing, fixed costs are also added into the cost. So I'll repeat again, in absorption costing, the product cost it consists of 4 cost elements: direct material, direct labor, variable production overhead, and fixed production overhead. Whereas in marginal costing method, the unit of output, the total cost consists of only 3 items, and all 3 are variable costs: material, labor, and variable overhead. Fixed overheads you will not include. Marginal costing we use for internal decision making purposes. Absorption costing we use it for reporting purposes. What do we mean by reporting purposes? Like when you make your balance sheet, in your balance sheet, when you calculate your cost or your value of inventory under IAS 2, you use absorption costing method, which means that the value of inventory in the balance sheet will consist 4 cost elements including fixed overheads, because IAS 2 requires us to use absorption costing method. This marginal or variable costing method, we use it for our internal purposes, analytical purposes, decision making purposes. So now let's start the chapter. Marginal cost and marginal costing. So let's first understand few concepts. It says that marginal costing, it is an alternative to absorption costing method. Yes, these are 2 different methods, but the purpose of both is to calculate the value of the unit of output. Whatever you make tables, you make chairs. So what is the value of making one table? What is the cost of making one table? So in order to calculate the cost of making one table, you have 2 methods: absorption costing and marginal costing. So it's just an alternative. In marginal costing, only variable costs are charged as cost of sales, and contribution is calculated. What is contribution? Contribution means sales revenue minus the variable cost of sales. I'm going to explain this contribution in more detail in the next slide, don't worry. So what you need to remember here, that marginal costing, you only include variable cost. Closing inventories or work in process or finished goods, they are valued at marginal production cost. Marginal production cost means variable production cost, which means the 3 cost elements. Fixed costs are treated as a period cost and are charged in full to the profit and loss account. Fixed cost we do not add into the unit of output. We consider them as period cost. I'm going to explain this also in the next slide. Here I'm just showing you the summary. So don't be scared. We are going to discuss these things in detail. Marginal production cost per unit is usually consists of the following: direct material, direct labor, and variable production overhead. I just told you in the previous screen 3 cost elements, and all 3 are variable costs. Concept of contribution. Okay, this is what I said before. What is contribution? Contribution means selling price minus all variable cost, direct material, direct labor, and variable production overhead, and also variable selling cost. Now you should remember, contribution does not mean sales minus variable production cost. Contribution means sales minus all variable cost. So whatever you have variable cost, maybe they are production, maybe they are non-production. Contribution is selling price less all variable costs. You've got selling price X dollars, then you have variable production cost and you have variable non-production cost. You subtract both of them, what you get is contribution. Now that's not your pure profit. From this contribution you still have to subtract your fixed cost and then you get profit. But what you need to remember, selling price minus all production cost, all variable cost, whether production or non-production, both will be subtracted, you get contribution. This word contribution we will use only in marginal costing, and we are going to see it in the next slides because this is one word we will use a lot. So you've got marginal costing card. So you have direct materials, just like you made a cost card in your production, in your absorption costing in the previous chapter. So this is the cost card for marginal costing. So what includes in the unit of product is direct material, direct labor, and variable overhead, and you call it marginal cost. And when you add fixed overhead, then you call it full product cost. So this cost you use in absorption costing and this cost you use in marginal costing. So the value of inventory under marginal costing or under absorption costing, the difference is only the fixed production overheads, the fixed overheads, and of course the production fixed overheads. Now let's start with an example. If we want to understand it clearly, let me give you a very simple, very basic example. It says that a company manufactures and sells tables. Data for the period is given below. Prepare income statement using absorption costing as well as marginal costing method. So what we are going to do, we just created some hypothetical data, and based on that data we will make our income statement under absorption costing and under marginal costing, and we will see if there is any difference in profit, and we will find out why there is a difference in profit in two income statements. So we say that direct materials are $20. So we make tables. So within one table, direct materials are $20, direct labor is $10. Then you have overheads, which are fixed production overheads. You've got factory rent, $2,000. The factory insurance is $2,000. Factory depreciation is $1,000. So your total fixed overheads are $5,000. And then we say our production is 1,000 units. So it means that if you produce 1,000 units, your fixed overheads are $5,000. So here we can calculate our OAR. If you remember from previous chapter, we said overhead absorption rate. Overhead absorption rate was your budgeted overheads divided by budgeted activity. So $5,000 divided by 1,000 units is $5 per unit. So it means that in each table, $5 is fixed overhead. So we add it here. Overhead cost is $5 per unit. Then we got sales, which is 700 units. Now, if you pay attention, our production is 1,000 units. We produced 1,000 units, but we are selling only 700 units and our selling price is $50. So now all of the information is complete with us. We know what is the selling price. We know how much we produced. We know how much we sold, and we know the costs as well. So now we can make our income statement. So we have to prepare two income statements. One we will prepare using the absorption costing method, and the other one we will prepare using the marginal costing method. So first let's make absorption costing. Our sales was 700 tables, selling price was $50. So our sales revenue is $35,000. Then we have to subtract the cost of sales, and you remember cost of sale is opening inventory plus purchases minus closing inventory. So opening inventory was 0 because it was not given in question. So we assume that opening inventory is 0. Add purchases. This is the formula for cost of sales. Opening inventory plus purchases minus closing inventory. So in this case, our purchases are our production, which is 1000 units. And each unit cost is material, labor, and fixed overhead. 20 plus 10 plus 5. So it makes 35. So 35,000 we incurred in production. But this is the cost for 1000 units. You did not sell 1000 units. You only sold 700 units. So it means that our cost should also be for 700 units. So this is the cost for 1000 units. So now I subtract, I say less closing inventory, 300. So 300 units we did not sell because we produced 1000 and we sold only 300. So those units which you did not sell, which are in your closing inventory, their cost should be subtracted. So this cost of 300 units, which is 300 multiplied by 35, 10,500 I subtracted. Now in my income statement, this is the revenue from 700 tables and this is the cost of 700 tables. That's what you do in your ACCA F3. You will learn it in more detail. I'm not focusing it a lot here because it's not needed in F2. I'm just showing you for an example. So you should understand that when you record your revenue from 700 tables, you should also record the cost of 700 tables. So you cannot say, you cannot put you cannot put full 35,000 here because 35,000 is the cost of 1000 tables. I take revenue from 700 tables. So cost should also come from 700 table, and cost of making one table is $35. So 1000 multiplied by 35 and 300 multiplied by 35. Here you get your gross profit, which is $10,500. Now that's your income statement under absorption costing method. If I want to see it under marginal costing method, it will look like this. Sales 700 times $50, 35,000 like before. Cost of sales are opening inventory, again 0 because in question there is no opening inventory, and add purchases. Now if you pay attention, this time we put only 20 plus 10. We did not add 5. Here we put 5. Here we do not put 5. Because we said that in marginal costing, you only include the variable cost, the material and labor. You don't add fixed overhead. These $5 were fixed production overheads. So I don't add them here because under marginal costing, we don't add them into the product cost. So 1000 multiplied by 30, it is 30,000. And then I say less closing inventory 300 units, just like before. But cost, I don't charge 35, we charge only $30 because that's the variable cost. Fixed cost we do not include. So it makes 9,000. So your cost goes there, cost of sales 21,000. What does that mean? It means that the selling price or the revenue from sale of 700 units is 35,000 and the marginal cost of producing 700 units is 21,000. You can consider it 700 multiplied by 30. Remember, cost of making one table is 30. So 700 multiplied by 30 is 21,000. Now what you get is called contribution. That's the concept of contribution. Under absorption costing income statement, you make gross profit. Under marginal costing income statement, you use the word contribution. Contribution means selling price minus variable cost. In this example, I only subtracted variable production cost because they did not give us any, non-production cost, so we just ignored. So anyways, whatever variable costs were given, we subtracted. And now fixed costs are remaining. Here we added this $5 inside. Here we did not add any fixed cost because in marginal costing, we subtract fixed cost in full. We say less fixed cost $5,000 because that was our total fixed cost. 2,000 depreciation, 2,000 was rent, 1,000 was insurance. So total $5,000 we subtract and we say our profit is $9,000. Now if you see that profit under absorption costing was 10,500, profit under marginal costing is 9,000. So there is a difference in your profit of $1,500. Where this difference comes from, what is the source of that difference? So that difference comes like this, that the difference in profit is due to the difference in opening and closing inventories. So the rule is that whatever is the difference between opening and closing inventories multiplied by the fixed overhead in each unit. If you remember that our opening inventory was 0 and closing inventory is 300 because we produced 1000 units and we sold only 700 units. So it means that 300 units, they were in our closing inventory. And in each unit, our fixed overhead was $5. So 300 multiplied by difference in opening and closing inventory, which means 300 multiplied by overhead in each unit, 300 multiplied by $5, 1500. This is the difference, 1500. So whenever your opening and closing inventories are not same, if I had 300 units in opening inventory and 300 units in closing inventory, if opening closing inventory is equal, then absorption marginal costing profit would also be equal. But if there is a difference in opening and closing inventory, then there would be a difference in the profit. And the difference in the profit would be the difference in the opening closing inventory, like 300, multiplied by fixed overhead within each unit. How much was fixed overhead in each unit? Now that's 1500. So let's see why this difference arises. Now first I calculated that where it comes from, but now we need to understand that why does this happen. So let's go to the next slide and see why does this happen. We say that absorption costing allows you to add overheads in the inventory, and if any units are unsold, like in our example 300, then units are transferred to the next period because we did not charge 300 units in income statement in cost. We only charged 700. These 300 units are not sold. We transferred them to the next period. We said that whatever we sold, only the cost of the sold units will go. We said cost of sales, which means the cost of the sales. What was sale? 700 units. Cost of 700 units. 300 units which you could not sell, they transfer to the next period and they take their cost to the next period as well. See, let me read it again. If any units are unsold, then units are transferred to the next period and they also take their fixed overheads to the next period. So if you remember, there were 300 units which you transfer to the next period. In each unit there was $5. So when the unit moved to the next year, it also took $5 multiplied by 300 units. 1500 units of fixed cost is transferred to the next year. In previous example, the value of closing inventory was 10,500. Under absorption costing, we said 300 units multiplied by 35, 10,500 was your closing inventory. This closing inventory 10,500, it includes 1,500 of fixed overhead. So fixed overheads are transferred to the next period. Marginal costing, on the other hand, it says that fixed costs are period cost. Fixed costs are period cost. Period cost means they relate to 1 year and they cannot be transferred to the next period. Marginal costing says you cannot transfer the fixed cost of 1 year to another year. Whether you sell more or less, full year's fixed cost for the period must be deducted from the income statement. And therefore you deducted 5,000. If you remember marginal costing income statement, we subtracted all 5,000. Let me show you again. You see all 5,000 we subtracted. We said whether we sell or we don't sell, fixed cost in total we will subtract. So the previous example, the value of closing inventory was 9,000 because 300 units multiplied by 30 was 9,000. Because here 300 units, you only valued them at material $20 and labor $10. Fixed overheads you did not add. So the value of closing inventory was less in marginal costing and more here. So what absorption costing in general, or the bottom line is, what does it allow you? What you do, some of the fixed cost which you already have paid, like rent, insurance and depreciation, whatever, you add some of that fixed cost into the unit of output, like $5 you add into each table, and then these tables you transfer to the next year, and some of the fixed cost also transfer to the next year. So because you are transferring your some of the cost next year, therefore your profit was more. So where do we use absorption costing and marginal costing? Absorption costing you use for your financial statement preparation. When you make your income statement under IFRS, you use absorption costing method. Marginal costing method I use for my internal reporting. Because my manager, my boss, my owner will not allow me to transfer fixed cost to the next period. Absorption costing says that if you did not sell the goods, don't charge fixed cost, let them transfer to the next year, don't show them an income statement. Marginal costing, if I go to my manager and I say that because I did not sell the fixed cost, because I did not sell 1000 tables, therefore I did not charge the cost. I did not charge the rent or depreciation or insurance. My boss would never agree with that. He would say that whether you sell or you don't sell, you paid the rent, you paid the insurance. Because you have paid, you must subtract it in full. How can you transfer your rent of this year to the rent of next year? You cannot. If you don't sell it, don't sell it, but fixed cost must be subtracted. So that's for internal analytical purposes or for decision-making purposes. So absorption versus marginal costing. Absorption costing is used for routine profit reporting and must be used for financial accounting purposes under IAS 2. So this is our formal reporting. Marginal costing, it provides better management information for planning and decision making and is used for internal reporting and decision making. So this is for our own internal purposes, marginal costing. Reported profit figures use the two different approaches will differ if there is a change in the level of inventories in the period. I explained to you that if opening and closing inventories are different, your profit calculation will also be different. If inventory level increases, absorption costing will report higher profit. Yes, remember always, if closing inventory is more than opening inventory, then absorption costing profit will be more than marginal costing. Just in our example, our opening inventory was 0. Closing inventory was 300. Because closing inventory was more, therefore our absorption costing profit was also more than marginal costing. If inventory level decreases, absorption costing will report lower profit. Yes, it goes vice versa. If you imagine that your opening inventory is less, your closing inventory is less than the opening inventory. In that case, your absorption costing profit will also be less than the marginal costing profit. In marginal costing, fixed costs are treated as period costs and are written off as they are incurred. We discussed that in marginal costing, you say that your fixed costs do not add them into the units. Because if you add them into the units, wherever those units will transfer to the next period, fixed costs will also be transferred. That is not allowed under marginal costing. Marginal costing says that your fixed cost is a period cost. It is for some year, for some period. You charge it fully into that period. In absorption costing, fixed production costs are absorbed into the cost of the units and are carried forward in inventory to be charged against the sales for the next period. We discussed that already. Marginal costing is an alternative method of accounting for cost and profits which rejects the principle of absorption costing. Marginal costing profit statement, when you make sales, cost of sale is opening inventory at marginal cost plus production cost, variable cost only, plus minus the closing stock, and that is called marginal cost, and what you get here is called contribution. And this is here you've got variable non-production cost. So this is my sales, this is my variable non-production cost, and what I get is called contribution. And then you subtract the fixed cost and what you get is your net profit. So contribution means sales minus all variable cost, and then you say minus the fixed cost and you get profit. And fixed cost means full fixed cost. Absorption costing profit, on the other hand, it says sales, and then cost of sales you say opening stock plus purchases, and you measure it at full cost, which means with fixed overheads. Then you've got production cost, which are variable cost and also fixed overhead. This was not included in marginal cost. This we include here in fixed cost. And then you say closing stock you subtract, and then you do adjustment for under over absorption. If you remember in last chapter when we were doing absorption costing, we learned what is under absorption, over absorption. So you add or subtract under over absorption, and what you get there now, that is called your gross profit. And after gross profit, you subtract your non-production costs and you get your pure profit, which is called net profit. So reconciling the profits between the absorption and marginal costing, you say difference in profit is equal to change in stock, which means change in inventory, multiplied by the overhead absorption rate. In our case, it was 300 units multiplied by $5. But which profit is higher, absorption costing profit or marginal costing profit? So here you should remember the rule that you've got production and you've got sales, and then closing inventory and opening inventory, and absorption costing profit and marginal costing profit. If your production is equal to sale, which means you produced 1000 units and you sold 1000 units, so whatever you produced, all of that you sold. So it means your closing stock will be equal to opening stock, and if both inventories are equal, both profits are equal. But if your production is more than your sales, you produced more and sold less, like in our case 1000 I produced and 700 I sold. So in that case, closing inventory will be greater than opening inventory, just like in our case it was 300 units and it was 0. And then absorption costing profit will be more than marginal costing profit. And the last scenario is if production is less than sales, which means that you produced less but you sold more. How did you sold more? Because you had some inventory in the beginning. You had some inventory from the last year. For example, I have an opening inventory 500 units, and then I produced 1000 units. So now I have 1500 units, because 500 I have opening inventory from the last year plus 1000 I produced. So my production is 1000. So total available is 1500, and I sold 1200 units. So if I sold 1200 units from 1500, my closing inventory will be 300. Now opening was 500, closing is 300, like this example. Okay, closing inventory is less, closing is 300, opening is 500. So in that case, absorption costing profit will also be less than marginal costing, because your production is less, 1000, and your sales are more, 1200. So therefore your closing inventory will be smaller than opening inventory, and absorption costing profit will be smaller than marginal costing profit. That's all with this chapter. It was not a very long chapter, but it's interesting and it's important, and definitely you get questions from here. You should do questions. There is a next video in which we will do some practice questions. Watch that video and then move on to yourself and do some questions by yourself as well.